Welcome everyone to Vested Interest. This is Shane, and in this video, we are going to cover four stocks I am looking to buy in the month of January, as well as two ETFs for the entire year of 2024. I have not decided yet whether I'm going to be investing into these two ETFs every week, once a month. I'm thinking that I might do it once a week so that you could join me on this challenge, buying one of these, pick one of these ETFs, or do both if you'd like, and do these all year long, every week. Whenever we add to the portfolio, this just becomes two that we add to every week. The other four stocks we're going to take a look at are CVS, Kroger, Procter and Gamble, and Johnson and Johnson. But before we get into the video, I wanted to take a moment and wish everyone a very, very happy new year. Hopefully you had a great New Year's Eve. Holiday season is over. We are into the new year. Welcome to 2024. Tomorrow will be the first day of investing. And for those of you who may be stopping by for the first time on this channel, we focus on dividend growth investing, buying stocks in good companies that pay growing dividends and hold them for the long term. Well, it's not rocket science. In my opinion, the best way to do anything. Keep it as simple as possible so it really boils down to consistently investing, dollar cost averaging on a weekly basis into dividend growth stocks in growing companies with positive cash flow that covers the dividend and have a high return on invested capital. I cover all my investments every week, Sunday morning portfolio updates, all the activity in the portfolio on this channel. I do not have a paid Patreon account, a paywall to get through, or any of the other ways YouTubers use to charge you to see what they are doing. We all have enough to pay for, so it's free to see what I'm doing in my portfolio every week. But if you'd like to help the channel, take a moment, hit the thumbs up, hit the subscribe button, ring that notification bell, and join us on our journey to financial freedom. Join the vested interest community. Drop a comment down below and let me know if you have started your own journey as well. And let me know if you are going to do the weekly challenge for the year of 2024. SCHD and VTI will be the two ETFs that we're going to cover in this video, and the two that I'm looking to add to, I believe, every week in my portfolio. So if you'd like me to join me on that journey, adding these ETFs every week, again, hit that thumbs up, hit the subscribe button, and hit the notification bell so you're notified whenever we drop any new content. So this is the Vested Interest Stock Screener. This is how we will be looking at companies in the Stock Pick of the Day series that I do Monday through Thursday. So again, hit that subscribe button so you can watch those videos with us. They'll start back up tomorrow as the market opens back up. It's not open today on New Year's Day. But this is how we look at understand a business. We want growing free cash flow over the next 5 years into the future, a growing dividend payout ratio of 75% or less. Does not apply to REITs or BDCs or companies like those. Check the valuation based on dividend yield theory. Buy below current cost basis or within 15% of its 52-week low. Return on invested capital and return on equity, I like 10% or better. Earnings per share growth equal to or greater than its industry or 5% plus. And if it's a financial company like a bank, I like to look at price to book. 1 being fair valued for banks, below 1 being undervalued, and over 1 being overvalued. And for me to see a company as investable, it must meet 5 of 8 of the criteria above. If it's a financial company, 6 of 9. So you can use this screener, you can adjust this screener. Don't just blindly copy what I'm doing. Make sure you have your own investing criteria. We all have our own and different investing criteria, different timelines for retirement. I'm in my mid-40s, so my investing criteria is going to be different than someone in their 20s or their 30s or their 50s or their 60s and so on. And it will be different for if you have a custodial account like I do for my kids. I have much different stocks in their custodial accounts, primarily ETFs, because they have a very long time horizon. So just make sure you're putting your own criteria together and investing according to your criteria. First up, we are going to take a look at Kroger. This is out of the consumer staples sector. The Kroger company, ticker KR, again out of the consumer staples sector. We're going to focus at the close here. I show the after hours as well, but really this is the close of regular trading on the last day of trading for December 29th, 2023. So we're going to focus on this number here, $45.71. They have a 52-week range, low of $42.10, as high as $50.36. So they are still sitting closer to their 52-week low, though they are starting to creep up. I'd love this one to pull back into the $44 and under range, but I'm going to keep adding. Now, they estimate fair value is about 6% more than where it's currently at, so they feel like this one is a little overvalued right now. We'll see if that's the case here. Market cap of $32.885 billion, a beta of 0.47, so they're less volatile than the overall stock market. Price to earnings ratio, PE ratio, sitting at $17.79. That's not terrible, but it is getting up there a little bit, much more than this, and I would be looking to back off it. Earnings per share sitting at $2.57 per share. Next earnings date, February 29th to March 4th. So if you're interested in this company, maybe look at the earnings date, their earnings call on that time, somewhere in there that week. Forward dividend yield, $1.16. They do have a nice starting dividend yield of 2.54%. Ex-dividend date was November 14th, and they paid out on December 1st. And a one-year target, at least according to Yahoo Finance, where I pulled this information, of $50.20 per share. Now, I like to get into statistics, look at dividend yield theory to see if this is presenting any value there according to dividend yield theory. To do that, we'd go down to dividends and splits. We look at their 5-year dividend yield average, 2.04%. We compare it to its current 2.54, or over here where it says forward dividend yield, they're the same number, 2.54%. And since it is higher than their 5-year average, that speaks to some undervaluation on this one, at least according to dividend yield theory. Payout ratio is under the 75% I look for at 41.63%. So very low payout ratio, very good metrics overall. Let's continue. I like to get in and look at free cash flow under financials. You're going to find a lot of good information there. Financials covers the income statement, the balance sheet, their assets over liabilities. You can see if they're paying down debt. You can see if their margins are expanding. A lot of good information in their balance sheet, or in the under the financials tab. We're going to look at free cash flow because we want growing free cash flow to cover the dividends as well as pay down debt, reinvest back into the company, make acquisitions. That's all the things free cash flow can do. And they also typically, if you have growing free cash flow, you have growing dividends, and we want growing dividends over time. So let's take a look here. 2020, $1.5 billion. Big jump up in 2021 to $3.9 billion. Bit of a drop in 2022 to $3.5 billion. And it looks like so far to date, $2.3 billion for 20. I don't know if they've announced their final numbers for 2024, but that's where they're at to date. So overall, from 2020 to current, looks like some positive growth in free cash flow. And you can also see they are repurchasing their own shares, which is also nice to see. I like that. Now let's look at return on equity and return on invested capital. I like 10% or better for both of these metrics. Return on equity sitting at 17.6%. That beats the 10% I'm looking for. Return on invested capital is a little lower than I'd like at 6.55%, but not egregiously so. And for a company like Kroger, which is a grocery store, these margins, the return on invested capital, that's actually pretty good. Now, I like to look at EPS growth as well, earnings per share growth. I like 5% or better. This one estimated over the next 5 years sitting at 11.37%, so twice what I'm looking for there. And revenue growth is sitting at 2.07% as a bonus metric there. Again, I have 70 shares of Kroger. This is an existing position I've been adding to recently. I'm going to continue to build this one out. My cost basis is $44.44, so a little over $1 less per share than where it currently sits, and I'd like to get to at least 100 shares on Kroger and then maybe back off, especially if it keeps running up. Like I said, when I started buying this, it was down in the high 42, low $43 range, and it's run up a little bit, as everything has. So I'd love this to pull back a little bit as I build the rest of this out. But let's keep going. So next up on the list, another one out of the consumer staple sector. This is Procter & Gamble, the Procter & Gamble company, ticker PG. Closed out 2023 at $146.54, 52-week range as low as $135.83, a high of $158.38. So it is kind of floating between that 52-week low and 52-week high here. They estimate that it's about 15% overvalued, but we'll see according to dividend yield theory if that is the case. Market cap of $345.379 billion. A beta of 0.45, so another one that is less volatile than the overall market. Price to earnings ratio, I will say this is a little elevated, $23.83. I always feel like Procter & Gamble is elevated. I always feel like this company sells at a premium. It is just one of those companies that does sell at a premium just because of the nature of the business. It's a very sticky business. It does well in good times and bad. And for companies like this, you typically are going to pay a little bit more, which I don't mind, but we'll see according to dividend yield theory if it is potentially undervalued or fairly valued here in a minute. EPS, earnings per share, is sitting at $6.15. Very nice EPS on this one. Earnings date is coming up in January here, the month we're in now. Can you believe it? Already in 2024. Again, Happy New Year. Welcome to 2024. January 23rd, 2024 here. Forward dividend, $3.76. Paid out on the year, they are a quarterly payer, so divide by 4. Nice dividend yield on this one as well, 2.57%. Ex-dividend date was October 19th. Looks like they paid out on November 15th, so you would be in line for the next dividend payout on this one. And a 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $165.48. Now, I like to get into statistics. Again, we're going to look at dividend yield theory, same as we did the other one. We look at all these companies exactly the same. This is also real similar to how I set up the stock pick of the day videos, except we have a little bit more information. So to do that, we look at the current 2.57%, right? Go to the 5-year average, 2.46%. Go to their current, same number, 2.57% forward dividends. So since it is higher, and it is just slightly higher, again, speaks to some potential undervaluation, real close to fair value according to dividend yield theory. So again, another one I'm going to continue to add to my portfolio. Now we're going to look at free cash flow again. That's under financials. A lot of good information here. Balance sheet, income statement, debt to equity ratios. Are they paying down debt? How do their margins look? All that good information in there. Still going to look at free cash flow. That's one of our metrics. We want growing free cash flow over time because we want growing dividends over time. Back to 2020, $14.3 billion. Jump up in 21 to $15.5 billion. Little drop in 2022 to $13.5 billion. Back up in 2023 to $13.7 billion, at least according to the last one. Looks like to date they're actually at $14.5 billion. So overall, from 2020, definitely seeing not a bunch of growth, but growth of free cash flow and really aggressive in their repurchase of shares, right? They are really repurchasing a lot of their own shares. Very, very nice to see. Now, again, we're going to look at return on equity and return on invested capital, like 10% or better. The return on equity for Procter & Gamble is 32.9%, smoking high. Return on invested capital, 18.06. Again, almost twice what I'm looking for there. EPS growth, I like 5% or better, sitting at 8.36% projected over the next 5 years, and revenue growth of 4.86%. This one really has great numbers overall, very good numbers. I'd like it to pull back a little bit more, but it's still there where I'm willing to add to it. My cost basis is way down here at $139.78. I have 32.706 shares. By the end of the year, another one I'd like to build out and have to over 100 shares. So I will probably, anytime this is under this 150, let's call it $150 range, I will probably 147, probably 148 right in there realistically. And so long as my cost basis doesn't get up above where it currently sits at 146, I would look to add to this till I brought this up to 100 shares. So this one might not be one that I just look to add in January, depending on where the cost basis stays at, but it might be one that I continue to add to until I get this to 100 shares as well. And this would become one of the larger, just like Johnson & Johnson, one of the larger positions in my portfolio if I was to do that. Now let's keep going here. We're going to look at CVS as number 3 on our list. Ticker CVS. This is the CVS Health Corporation. They are out of the healthcare sector. Closed out the year at 2023, $78.96. 52-week range as low as $64.41, as high as $93.41. So they are definitely closer to that 52-week low than they are the 52-week high. Another one I'd love to pull back further. Now, this one is one that Yahoo Finance does see as potentially undervalued. They see it as 60% estimated return. That means they see it as potentially 60% undervalued. That is very, very undervalued. I don't know that I buy that, but that's what they say. Market cap of $101.614 billion, a beta of 0.53. So you're noticing a theme here a little bit. All of these have very low volatility, right? Half the volatility of the overall stock market right here. Price to earnings ratio, PE ratio, sitting at $12.09 per share. That's pretty low for this company, in my opinion. EPS, earnings per share, sitting at $6.53. Very nice. Next earnings date, sometime between February 6th to February 12th. Forward dividend, $2.66 paid out on the year. They are a quarterly payer, so divide by 4. 3.37% dividend yield. So very nice dividend yield on this one. Ex-dividend date will be January 19th. So that's coming up here, first couple weeks in January. So if you were to buy them before that, you would get them for the February 1st payout. And according to Yahoo Finance, they have a 1-year target of $87.39. Now let's look at dividend yield theory again. To do that, we'd go into statistics. We'd go down to dividends and splits. We look at their 5-year dividend yield average, 2.87%. Compare it to the current 3.37%, over here 3.37%, and this is much higher than their 5-year average. That speaks to some undervaluation on CVS. That's part of the reason that I agree with that. So that's part of the reason I'm adding them. Very low payout ratio, 36.22% on this one. So very low payout ratio, lots of room to increase that dividend over time. Ex-dividend date, January 19th. Again, payout February 1st. Let's get down to financials. Again, lots of good information here. Balance sheet, income statement. We're looking at free cash flow. We want growing free cash flow. 2019 was at 10.3 billion. 2021 to 13.4, or I'm sorry, 2020 to 13.4. 2021 to 15.7. 2022 looks like a drop down to 13.4, but look at this. Started repurchasing their own shares again. And 2023, at least so far, they've announced 11.3. So I would say growing free cash flow from 2019 to date, not only growing free cash flow, but now they are buying back, at least since 2022, buying back their own shares. So really, really like the numbers on this one. Return on invested capital, return on equity, again, looking for 10% or better. Return on equity sitting at 11.9%, beats that metric. Return on invested capital, much like Kroger, this type of company, since it's not their only source of revenue, but their CVS retail stores is a big part of it. And retail typically does not have a huge return on invested capital. They're very capital intensive, but in line with its industrial average, or industry average. EPS growth, I like 5% or both or better. This is smoking that. 24.54% forecasted over the next 5 years. Very high earnings per share growth on this one, and a nice revenue growth forecast of 5.84%. Again, another one that I own in my portfolio. All these I own in my portfolio except for the ETFs. We'll talk about those in a little bit. I have 134 shares. My cost basis is $70.09. I would love, love, love for this one to pull back even more so that I can continue to add this. And this is at $78.96, and my cost base is $70.09. So again, I would love for this to pull back so that I can add a lot more to this. I would like that to happen, but I think it's going to continue to run up. We'll see what happens. Looks like maybe in the after hours they did pull back a little bit more. So maybe I get a better chance in January here than I have in December. I didn't really add much to CVS in December because it bounced up almost to $80 per share. But another one I'd like to add to over the next month. Let's keep going here. And the last one, the fourth stock that I want to add to, Johnson & Johnson, ticker J&J. This is out of the healthcare sector as well. So you can kind of see I'm seeing some potential undervaluation in the healthcare sector. There's other ones in the healthcare sector as well. We'll talk about some of the others I see value in, but these are the ones I'm looking to buy. Johnson & Johnson closed out the day at $156.74, and the healthcare sector, as well as you saw with Kroger and Procter & Gamble, I'm seeing some value in the consumer staple sector as well. So those two sectors are why I picked the stocks that I did. I'm seeing some undervaluation there. They're in my portfolio, and I'd like to build the existing positions out while they're presenting some value. That's the idea. 52-week rip. Let's get back to Johnson & Johnson at $156.74. 52-week range as low as $144.95, as high as $180.93, closer to that 52-week low than the 52-week high. Another one I wouldn't mind pulling back. It hit the 140s here a couple weeks back. I was able to snag a couple shares at 148, 149, and then it bounced back in the 150s. You can see here my position down here. I have 108.468 shares. My cost base is $161.26. So this is one of the ones I'd be bringing my cost basis down in, right? So I was buying it in the 160s. I love it in the 150s. I'd love it back in the 140s, but I'm going to nibble on this one since I have over 100 shares. This is currently the biggest position in my portfolio also. They, at least according to Yahoo Finance, they see it potentially overvalued. We have negative 7% estimated return according to them. Market cap of $377.317 billion, a beta of 0.57, so another one less volatile than the overall market. Price to earnings ratio, PE ratio, in this one I believe it's elevated. Hopefully that it's justified with this particular company, much like Procter & Gamble. I always feel like their price to earnings ratio is high, 29.40. Earnings per share sitting at $5.33 per share. They recently did a spinoff as well, so I'm wondering if that has impacted their price to earning ratio, and this might level out overall over time. But earnings date January 23rd. So tune in for that. For dividend, $4.76 paid out on the year. They are quarterly payer, divide by 4. Dividend yield on this one, nice starting dividend yield over 3%, 3.04%. Ex-dividend date was November 20th. Looks like they paid out December 5th. So you would be in line if you were to buy this one now. Now, I like to look at dividend yield theory. Same thing. We'd go into statistics. We'd look at their 5-year dividend yield, 2.65, compare it to the current 3.04, or over here, forward 3.04. And again, since this is higher than their 5-year average, it speaks to some undervaluation. Now here is one negative. Payout ratio 87.05. This has the highest payout ratio of all the companies we've looked at today, and it is above the 75%. So this metric, it does not meet that metric. It is over the 75% that I look for. But remember, it's got to meet 5 of the 8 or 6 of the 9 if it's a financial company. And overall, it'll hit all the other ones, but this one it does not meet. I like to look at growing free cash flow. Again, you'd look at financials, go to free cash flow. 2020, we're at 20.1 billion. 2021 dropped down to 19.7 billion. 2022 dropped down to 17.1 billion. But if you look at the repurchase of the shares, is almost double, so that's going to account for that drop. And 2023, I expect free cash flow to be lower because of the spinoff of Cavenue that they just did. So I am actually looking to see 2024 numbers before I say whether or not this is growing free cash flow or if it's declining, which is what it looks like, declining, even though they're increasing. Part of the decline can be accounted for the increase in repurchase of their shares. So this is one. I love Johnson & Johnson. It's just a dividend aristocrat, dividend king that's been around for a long time. Very solid business model. One of the only companies that is AAA rated. This one and Microsoft are the only two. So again, I am actually willing to overpay a little bit for Johnson & Johnson because of the type of company it is. But because of the Cavenue spinoff, I am waiting for 2024 numbers and going to compare them to 2022 and 2023 numbers before I really make a call on how the Cavenue spinoff has impacted this one. And I'm hoping that the impact is positive. But let's keep going here. Return on equity and return on invested capital, again, like 10% or better. Return on equity for this one, 47.1%, just smoking high. That's extremely high. Again, this company does very well reinvesting back into itself, so I am not worried about overpaying a little bit for such a great company. Return on invested capital, I like 10% or better, 22.12, smoking that number. EPS growth, I like 5% or better, 11.13%. This would be the only negative. Revenue growth forecast of 1.01%. But again, I'm not sure how accurate this is or how it reflects the spinoff from Cavenue. So I'll wait to see what's going on here. Another one, again, in my portfolio, 108.468 shares. Currently the largest position in my portfolio. So I will be adding, but it will be a nibble, maybe 1 or 2 shares per week over January. I'd like to get this to maybe 120 shares and then again back off. I don't want any one position to be over 10%, and this one's getting pretty close. My cost base is $161.26, so I'm bringing down my cost basis on this one, which doesn't bother me a bit. Those are the 4 stocks I'm looking for. Now let's jump into the 2 ETFs. And again, if you want to join me on this ETF challenge, where we'll do one, either pick one of the 2 that we're going to look at, or do both of them and do 1 share per week all year. We'd get to the end of the year and be at 52 shares of these 2 ETFs. Join me on that. Drop a comment down below. Let me know, are you going to do that? Are you going to join this challenge? And let's look at those 2 ETFs. We'll start with the Schwab U.S. Dividend Equity ETF, ticker SCHD. Closed out the year at $76.13. 52-week range as low as $66.67, as high as $78.23. It is closer to its 52-week high than its 52-week low. Net assets, $48.88 billion in net assets. PE ratio, 14.44, so low compared to the overall market. Dividend yield sitting at 3.62%, so you'd start out with a very nice dividend yield. Year-to-date return 4.83%, so it is lagging the overall market. A beta of 0.78. It is less volatile than the overall market. This is another key metric you want to look at if you're buying any ETFs, index funds, anything like that. Expense ratio 0.06%. That's low. That's extremely low. So you're not using a lot of capital to pay SCHD Schwab to manage this ETF. Now, here are the top 10 holdings. There's over 100, I believe 105 holdings total. So you'd want to look at all the holdings if you want to get a better idea of this particular ETF. But here are the top holdings. Verizon Communications, 4.5%. Broadcom, 4.4%. Amgen, 4.36% of the ETF. Coca-Cola, 4.04%. PepsiCo, 3.9%. Home Depot, 3.89%. AbbVie 3.88, Merck 3.87, Texas Instrument 3.71, and BlackRock 3.70. So whenever you buy this ETF, you buy all of the positions in the ETF. Like I said, I believe the ETF is sitting at 105 holdings. These are only the top 10. So you're going to own a little slice of each one of these companies in there, all 105 of them. And these are the percentages based on 100% of the 48.88 billion that are allocated to each one of these positions. And again, you'd want to look at all of them together to see what all you would hold, but that gives you an idea of the top 10. So that is ticker SCHD, Schwab US Dividend Equity ETF. That's the first ETF. And next, Vanguard Total Stock Market Index Fund, ticker VTI. So you'd be buying the entire stock market. This is over 3,000 companies, the entire stock market, United States stock market, whenever you buy VTI. And for this one, 52-week range as low as $188.93, as high as $238.74. Definitely closer to this 52-week high than 52-week low, and that is because the stock market is screaming up right now. So you're going to buy, and whenever you dollar cost average, keep in mind, you're going to buy sometimes at the high. You're going to buy sometimes at the 52-week low. It's just the way it is. That's why you dollar cost average on this one. Again, if you're up to the challenge, if you're willing to jump in here, this would be one we'd buy every single week along with SCHD. So regardless of what the market is, let's say at the close of business on Friday or that day, the last day of the week on Friday, I'm going to buy a share of VTI and a share of SCHD. One a week. So when we get to the end of the year, we should have 52 shares. And maybe if it drops way low or something, I'll add a couple. But for the challenge, and you don't have to do both, maybe pick out SCHD, or maybe you like VTI better. Pick out one of them and see if you can join me on this challenge. One of these shares every week on Friday. Go ahead and drop the comment down below and let me know if you are going to do that. 52-week range as low as $108.93, as high as $238.74. Net assets, $1.39 trillion in assets. Very, very large ETX fund right here, right? Vanguard Total Stock Market Index Fund. A lot of money sitting in this fund. Won't be a lot of volatility, I wouldn't imagine, unless people start pulling out their money. And you can see the beta here, one, it is the market because it's the whole stock market, so it's going to match the market. PE ratio 22.31. Again, that's about where the market's at because it's matching the market. Yield of 1.48%. So it has a low dividend yield because it's just the market, whatever the market yield is going to be. And year to date, 26.54%. So this one, if you'd have bought last year, in here, you'd have made 26.54% of your money. You could probably average that out because, again, you'd be dollar cost averaging in every week. But very nice overall return. Beta of 1, it matches the market. And again, this is what you want to pay attention to the expense ratios. This is what you're paying in the fees for Vanguard to manage this fund. Right? Very, very low expense ratio at 0.03%. And here are the top 10 holdings for this one. Apple, 6.37%. Microsoft, 6.36%. Amazon, 3.06%. NVIDIA, 2.48%. Alphabet, 1.77%. Meta, 1.64%. Alphabet Class C. That was Meta Class A. Alphabet Class A. Alphabet Class C, 1.49%. Tesla, 1.46%. Berkshire Hathaway, 1.45%. And United Health Group, 1.16%. Again, overall, VTI, I believe, has over 3,000 positions in there, and it is market cap weighted. So, yeah, I think Apple sits at 6.6% of the overall market. That's what you're going to get, 6%. These will change over time. That's why you're paying this 0.03%. They buy in and out of these positions, all of the positions, to keep them accurately weighted compared to the overall market. But you are basically buying, whenever you buy this VTI, Vanguard Total Stock Market Index Fund, you are buying the United States stock market, not just the S&P, not just the NASDAQ, not just the Dow. You're buying everything, all the companies, over 3,000 of them in the American stock market, right? Now, here are some other companies that I see value in right now as well. Pfizer, very undervalued in my opinion. I know some people are freaking out because part of the reason this is undervalued is they are not benefiting as much from the COVID vaccines, but that was never the biggest part of their company anyway. So I think all of the hubbub over that is a little overblown. So I am taking advantage. I've been nibbling on this one, 4, 6, 8, 10 shares of it every time I'm adding. I don't know that I'll continue that through 2024 because this is becoming a pretty big piece of the pie as well. And healthcare overall, I want to add to J&J. So I'll still probably nibble on this one throughout the year as it presents value. Right now, it definitely is. Realty Income, another one I feel like is presenting decent value right now. Enbridge, and this is Pfizer out of the healthcare sector. This is the monthly paying real estate company out of the REITs and real estate sector. Enbridge is an energy company, right? This is also a Canadian company, so there are some tax implications, as well as Nutrien, another Canadian company. Both Enbridge is energy and Nutrien is out of the material sector. Genuine's Parts Company. I feel like there's some value in this company right now. If you're looking for something in the industrial sector, right, there's a good one. Owens Corning. Let me talk through this. I do not actually see value in this one right now, but as soon as I do, this is one I'm going to build out. Really like this company, want a little bit of a pullback, and it may be one that I go outside of some of my rules as far as buying within 15% of its 52-week low, because I believe like we are going to experience a housing boom. And this is my play on the housing boom. I'm also looking at a couple of housing builders, D.R. Horton, Pulte, Lennar, a couple of housing companies that I may look to get in sometime this year as well. Right now, I feel like they might be a little overvalued, but I do want to build out this company as soon as it presents value. NextEra Energy is the one that I feel is presenting value right now. This is a utility company out of the utility sector. So these are some other companies that I see value in right now as well. Obviously, I can't invest. I'm limited on funds just like everybody else, so I can't invest everything that I see value in right now. But these are some other ones if you're looking for some other suggestions, and you can do your own due diligence. Go through the video or go through these companies just like we just walked through the video and see where there might be value for you or if there are other ones in your portfolio. But make sure you're doing your own due diligence, your own research. Don't just buy something because some stranger you don't know and we've never met. So you have no idea how smart I am or anything that recommends you on YouTube, right? I'm just an average guy who goes to work every day, married with 2 kids. So I don't have a background in this. I'm not a financial guru or financial advisor. I just do my own research and I share exactly what I'm doing, what I'm buying with you weekly. So if you are into that, hit the like button, share with anyone you think that might find value in the content, drop a comment, let me know what you are looking at for January 2024 and for 2024 overall. Do you have investing goals that you've set for yourself, personal goals, any new criteria you might set up for yourself, savings goals, buy a new house, any of that, drop it in the comment section down below. I do read and respond to the comments. I'm always interested to see your questions, opinions, or suggestions for future topics. So if you have any suggestions for the Stock Pick of the Day series, go ahead and drop that down below. And that's really it for this one. Again, happy New Year. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for spending some of your New Year's Day with me. Really wish you the best in this new year, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. If investing involves risk, you can't lose money. You should never invest any amount in comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.